How small apartment investors can practice using the capitalization method and discounted cash flow analysis. Gather sample income and expense data. Income includes rental income and any additional revenue, for example, parking and laundry. Expenses include property management, maintenance, insurance, taxes, and utilities. Calculate NOI by subtracting operating expenses from gross income to determine the net operating income for the capitalization method. Apply the capitalization method. Select a market cap rate. Research local market cap rates for similar properties. For practice, assume a typical cap rate in your area, for example, 6 to 7%. Calculate property value. Divide the calculated NOI by the cap rate. This practice exercise shows how the cap rate impacts property value based on income potential. Practice discounted cash flow or DCF analysis. Forecast cash flows. Project annual cash flows based on anticipated income and expense growth and determine an expected sale price or terminal value at the end of the holding period. Select a discount rate. Choose a discount rate based on market returns and investment goals, typically in the 6 to 10% range for stable properties. Calculate present value. Discount each future cash flow and the terminal value to the present, summing these values to estimate the total property value. Analyze and compare results. Compare valuation estimates. Review and compare the property values generated by the capitalization method and DCF analysis. Differences in value may suggest the impact of income stability, growth expectations, and investor return requirements. Use these valuation results to assess whether the property aligns with your target returns, risk tolerance, and financial goals. Additional tips for using valuation methods. Adjust for market dynamics. Cap rates and discount rates are influenced by economic conditions, so stay updated on local market trends and interest rates. Sensitivity analysis. Perform sensitivity analysis by adjusting cap rates or discount rates, observing how these changes impact property value. Use realistic projections. When forecasting cash flows, use conservative estimates for income and expense growth to avoid overestimating the property's value. Summary. Understanding the income approach, including the capitalization method and discounted cash flow analysis, is essential for accurately valuing multifamily properties in apartment investing. By practicing with sample income data, NOI calculations, cap rates, and future cash flows, small apartment investors can gain confidence in estimating property values based on income potential. These valuation tools enable informed decisions, supporting effective investment analysis, property acquisition, and long-term financial planning.